Okay, guys. Well, thanks for joining. We're excited to be offering this session. The New York School of Finance is offering, just for you guys that are just joining, a series of 2-hour crash courses just taking you through the whole modeling rigor. And we'll be saving this and uploading it. Just a couple things. One is there's a downloadable template. If you look on your dashboard under handouts, I just want to make sure you can download it. The second thing is I want to step through what we will be going through. I want to just give a quick overview of our program. And just to be fair, this is going to be a very simple version of the modeling. Our program is a semester-long program. It's 154 hours of instruction. And we obviously can't do all of that and record all of that. So we're going to do just a quick overview of how to build the core financial model, an M&A model, a leverage buyout model. We think will be a great refresher for those that already have it, and for those that don't, this is a great high level for you guys to be able to talk about it in interviews, and that's the point. If you want a deeper dive, I think a lot of you guys found us through Breaking into Wall Street, mergers and acquisitions. They have downloadable modules that go into a lot more detail than is just going to be worth going through in uploadable YouTube videos. I also want to mention that we have a bunch of books that I've written. They're up on Amazon. Financial modeling and valuation is what we're going to go through in the next few sessions. If you want a lot more detail, you can look at the book. They're up on Amazon as bestsellers. They're published by Wiley Finance. And just another quick thing to mention is we have a program popular in the summer. One starts in January, where we take people through our core morning crash course, analyst course, the same training that we do at a lot of the banks and firms on the street. And we place students into internships. And we're happy to say that we have placed 92% of over 600 students into top firms on Wall Street, and it's worked for a reason. So I don't want to make this do too much on that, but if anybody has any questions about that, feel free to reach out to us. Feel free to go to the nyschooloffinance.com. You can find me, Paul Pignataro, on LinkedIn, or Luis Romero, who will also be kind of presenting. So I want to just jump into what we're going to do, and just to give a quick introduction of myself and my colleague who will be doing the modeling, and you'll get to know over the next few sessions. I founded the school. I had graduated from NYU and had worked at Morgan Stanley for a few years. Then I moved over to a small arm of the buyout fund, T.H. Lee. It's called T.H. Lee Putnam Ventures. It was a $1 billion carve-out that focused on tech and logistics businesses, and then moved on to start this company. Luis Romero, my colleague, who will be doing a lot of the modeling training, was in M&A at Credit Suisse. He moved on to a hedge fund and is also working with us as a trainer. So you can find us on LinkedIn, connect with us, ask us any questions. So to go through what we're going to step through for the next two 2-hour sessions, I believe, 2 or 3, we'll be going through financial statements, building a full-scale model from scratch. We will, however, already have a model. You can see the template with hard codes in there. We're not going to go through looking through 10Ks and putting in financials of a full company. For us, the key instruction that we want to give is just how to project and link a financial model. This is enough stuff to get through interviews with. So we're going to go through the purposes and uses. What are the key statements? The income statement, the cash flow statement, the balance sheet, the debt schedule, the working capital schedule, the depreciation schedule, the individual line items, the flow between the statements, and the ability to build a balancing financial model. You will be able to build a full-scale financial model after these next sessions. So for anyone joining and have questions, and I see questions popping up, I'm going to stop after letting you know what we're going to go through in a second. After these 2 sessions, we're going to go through valuation. So what are the major valuation analyses? The comparable company analysis, present transaction analysis, discounted cash flow analysis, all getting into how much should I be paying for a particular entity. And Luis is going to go through a particular hedge fund investment that he's seen. I don't know, Luis, if you're going to do Monster.com or something else. He's going to apply these valuation strategies to that and give you an understanding as to how he looks at that perspective, and to see where he thinks using these valuation analyses helps determine if this is a good investment or not. For the next, so that'll be about 3 2-hour sessions. For the next session, we're going to go through mergers and acquisitions, And in mergers and acquisitions, there's 4 basic categories of instruction that we're going to go through that we think would kind of cover important competency for you guys. Basic asset acquisitions, basic asset divestitures, and then corporate mergers and acquisitions. So we'll go through the differences, what are the importances of one versus the other, and then most importantly, the accretion dilution analysis, the mini merger analysis. How do you think about that? How do you think about the impact of a target company's financials into an acquirer? And we'll go through a simple analysis. Again, great for you guys in terms of interviews, and great for establishing talking points for interviews. It'll cover a lot of basic questions that you might be covered if you get into an M&A kind of topic there. So we will build a simple acquisition model, a divestiture model, a mini merger model, and if we have time, we'll go through a fully consolidated merger model, go through the purposes and uses, and the ability to build the concepts of each. And then finally, leverage buyouts. We're going to go through a basic leverage buyout analysis, understanding LBO modeling, what it is, what are the concepts, and we'll build the model. And again, the whole purpose of a leverage buyout analysis is to determine if a fund were to invest in a company, what would be the potential return of the business after exit in 5 or 7 years. So we're going to go through that analysis, and hopefully you'll have some good talking points for interviews there. So again, the purpose of today is to begin with financial statements, and I'll kick it over to Luis. Unless anybody has any questions, I'm going to give it a second to look at. I know a bunch of questions that are popping up are just where can you go to download the template. Guys, if you look on your dashboard, you should have a handout. And again, for those that will be listening to this after the recording, there's just no way to download, obviously, in the recorded version, but there should be a handouts little section in the control panel that's popped up when you've logged in, and there should be an Excel file called NYSF Simple Practice Template. So if anybody else has any questions, great, just keep raising your hand, and then Luis, I'm going to kick over to you to start with the concepts and the modeling.
All right, great. Let me just...
I think I have to change the presenter to you, so I'll do that.
Yes, I think so.
And then that's done. So now you're the presenter.
Okay.
So if there's anything I'd left out, just feel free to jump in there.
Let me just show my screen right now. All right. Is my screen showing? Can everyone see my screen?
Yep, I can see it.
All right, great. Well, thank you everyone for attending the event, especially this Saturday morning. Like Paul mentioned, we're basically going to be walking you guys through how to build a full-fledged financial statement model, encompassing all the statements: income statement, cash flow, balance sheet, debt schedule, and all the supporting schedules as well. Before I even jump into the Excel, I just want to cover some key basic concepts through this presentation so that most of you guys, if you're familiar with it, great, it'll be a refresher. For those of you that aren't familiar with these concepts, you can definitely familiarize yourself, take notes after the presentation. You could definitely go back, replay it, and you could do a simple Google search and get more familiarized with what we're going to be discussing here. Keep also in mind that a lot of the stuff we're going to cover here may apply to your interviews in the future, especially those of you that want to go into investment banking. Some of the concepts that we're going to touch on will be questions that will be asked, and I'll try to make an emphasis on that. I'll try to point out and say, look, focus on this because this is a typical question that you may get asked in investment banking. So definitely take some notes. Hey, Paul, just one thing. Are you going to be monitoring the questions that are coming in? Will you be answering those questions on a one-on-one basis?
I'll monitor them, and I think it's yeah, I can look at them. I think if the questions are relevant for everybody, I'd like to find some stopping points where I can jump in and kind of mention them. Right now, a couple people are asking about downloading the file, and then just what the timing is for the next sessions. We're going to have to kind of look at our calendar, but it will probably be every 2 Saturdays, every other Saturday, just given our schedule. But we'll get them done before the end of the year.
Okay. All right, great. All right, good. So I'll just move forward here with the financial statement section. All right, guys. So I guess Paul went over this already. What's the main goal here is for us to really understand what financial statements are for, what are the purposes, and how do we use financial statements. We'll focus on individual line items on each and every one of the core statements, and then we'll focus on how to actually project out the model. How do we link the balance sheet to the cash flow statement, or the income statement to the cash flow statement, a debt schedule to the balance sheet, and so forth. So right now, this is very basic. I'm not going to go into every single slide here, but this is just a general overview of income statements and touching on some key concepts. So an income statement basically measures financial performance for a specific period of time on a company versus a balance sheet, which basically represents a snapshot on a specific date of all the accounts that they have on their books. Some key major line items to really focus on the income statement is your depreciation and amortization. Something here also that's very important to understand is how the line items on the income statement are being recorded, right? Or how we take them into account. Are they on an accrual basis? Is it a cash or non-cash line item payment? So one example of this is basically, cost of goods sold, your general and administrative expenses, taxes. These are typically cash expenses, right? So on your cash flow statement, when you see the net income takes into account, ideally, let's assume that it will be 100% of all of the cost of goods sold expenses. That will be a cash outflow. Same thing with your general and administrative expense. A non-cash expense is your depreciation and amortization. GAAP allows you to record depreciation and amortization as an expense in your net income statement, but then you have to adjust it and add it back into the cash flow statement because it's a non-cash expense that flows through the net income statement.
Hey, Luis?
Yes.
Are you flipping the slides?
Yes, I'm going to go through the slides.
You might be flipping them on... Do you have it open twice or on two screens? Because we only still see the cover page.
Let me take a look here.
Make sure you're flipping them on the...
All right, let me just make sure. I'm showing also the...
Sometimes if you have it... Yeah, sometimes if you open it up in presentation mode, it leaves one on the desktop and then the presentation version somewhere else, and WebEx won't see that one.
Okay, how about now?
Yep, perfect.
All right, good.
Yep, that's working.
So it's working? All right, good. All right, so following along with this, in terms of the core statement and the structure, hopefully most of you guys are familiar with this already. If you're not, simply do a Google search, and try to learn more about your income statement, balance sheet, and cash flow statement. But in terms of the core statement, you have your revenue at the top. You have your major categories of expenses. One is your cost of goods sold. The other one is the operating expenses like R&D, advertising, marketing, selling, general administrative expenses. Then after that, if you subtract all of these, you have your earnings before taxes, interest, depreciation, and amortization. This number, EBITDA, it's a very, very important number, and I want to emphasize on the importance of this, because when we're looking at business and we're analyzing business, we want to see how much cash flow the business is actually generating. So one way to measure that is by looking at EBITDA. EBITDA is basically a proxy for cash flow. In other words, how much cash is a business actually generating? This number is also very important because we use this in terms of a multiple. In finance, when we're looking at public companies and we're trying to identify, what is the appropriate valuation for them, we use trading multiples. So we may compare, their enterprise value over EBITDA and enterprise value over sales, just to see how our business is trading relative to its peers. We'll discuss a lot more of this in the valuation part of this module series. But again, I want to stress and emphasize the importance of EBITDA. Some of you guys should take notes on this and even go to Google and do a simple Google search on the importance of EBITDA and try to get familiar with what it is, because you'll typically get asked a simple question in investment banking about what EBITDA is. So once you subtract your depreciation amortization, you get your operating income. You subtract your interest expenses or interest income, and then you get your earnings before taxes. You adjust for taxes. You get net income from continuing operations, right? And then below net income from continuing operations, if a company typically has a one-time expense, that is relative or related to a natural disaster, or in the case or in the event where they sold a business, or or they've made any one-time gain or loss on the entire operations, they will record it in non-recurring events as a gain or expense. Then below that, you may have your dividends, minority interest, and then ultimately the bottom line is your net income. So right here again, very basic structure of your net income statement. And just to reflect this example, because it touches on your accrual, cash and non-cash basis, and how much cash you have on the balance sheet, let's walk through this example briefly. So you have Jan Gates, who owns a small wholesale distribution company. In its first quarter of operation, the company books $10,000 in revenue. Expenses include $1,500 in employee wages, $2,500 cost of goods sold, $1,000 for fuel, $1,500 in vehicle depreciation, and $1,400 in taxes. So at the end of the period, his trucking company has $2,100 in the first quarter of operations. And right here we see basically the basic structure of his company net income statement, right? $2,100 at the end.
Luis.
Yeah.
Can I address a few questions?
Okay.
And then I understand I don't want to hold you back too much. Somebody asked if depreciation, if you're looking at historicals, if depreciation is not shown on a set of annual reports, what do you do? And this is something that, again, Tim, this is something that, in these models, we're just going to focus on projections, but in our books, we cover that. We do a full model on Walmart where we go through building the historicals from scratch, or I also mentioned Brian's modules that you can kind of download, which are more interactive online. He goes through the historicals. There are times where a company on an income statement does not show depreciation, and that does not mean they don't have depreciation. Well, they could not have depreciation, but likely not. But it just means that they've lumped it together in SG&A or in cost of goods sold. So you need to look to another schedule to find out what that depreciation amount is, and then pull it out of either cost of goods sold and SG&A. So usually you can just look to the cash flow statement, and you can see what that depreciation and amortization is, and that would be an indicator of the fact that, number one, they have depreciation and the value. And then what you would do is you would create a line item for depreciation on the income statement. You want to make sure you're not double counting the depreciation, so whatever depreciation that you display, whatever amount that is, you need to just reduce the SG&A or cost of goods sold by that amount. Now, to figure out where it is it lumped in SG&A or cost of goods sold, or often likely both? That's a more difficult task, and oftentimes it doesn't really matter so much because you just want to pull it out of EBITDA. So, I think that's all I'm going to say about that for now, but you can look to our books where we get into a lot more detail on that. A couple other guys had some good questions on EBITDA, and I would say these are more valuation questions. These will come up in valuation. Why is EBITDA a proxy for cash flow? That question, guys, I would say to hold for, we'll do a breakdown in the DCF portion of the course where we talk about how EBITDA builds to unlevered free cash flow, and really a very a simplification of unlevered free cash flow is basically EBITDA less taxes, less CapEx. So there is a good reason for that. I'd save those EBITDA questions for valuation.
Okay.
Okay.
All right, good. So moving along here, so John basically, the truck needs some expense repairs in the amount of $1,000. So knowing that the company booked $2,100 in the first quarter in profits, John goes to the bank to take out $1,000, which he needs basically in repairment. But he goes to the bank, and then to his disappointment, there's only $100 in the bank. So how is it possible that you record $2,100 worth of profits in your net income, yet when you go to the bank on the balance sheet, you basically see $100 in your cash account. So the answer to this question is that he forgot that net income doesn't equals to actual cash. You have to take into account what actually goes on an accrual basis, right? And these line items right here are very important for you to understand the connection between the income statement and the balance sheet. So for example, your revenues, right? Anything that doesn't get paid as a total revenue from your clients, whatever gets paid on credit is going to go into your accounts receivables on the balance sheet. Your cost of goods sold, some of this may be deferred into accounts payable. Your operating expenses, right? Some of these line items may also be accrued or deferred into your accrued liability expense or into your accrued salaries on the balance sheet under current liabilities. And then you have your depreciation amortization, which again is a non-cash item in which you have to adjust. And you may have your taxes. Some of this tax may be paid in later years, so most of this stuff can also be deferred into your balance sheet. So Mr. Gay did not focus on the fact that net income is not equal to cash available. He did not consider that 35% of his customers paid on credit. So even though he reported revenues of $10,000, he only received 65% of that in cash. In case you have taken the profits of $2,100 and adjust for non-cash items such as the accounts receivables and the depreciation. Okay, so this is kind of like adjusting on the cash flow statement your working capital part, if you will, and also any other operating adjustments. So in the following slide, you're going to see right here you have the net income of $2,100. You subtract the cash that you didn't collect or the portion that was paid on credit by your clients, and then you add back the depreciation of $1,500. Once you take this total adjustment, you get $100. So that's basically how you can kind of adjust your net income so that you have an actual cash balance at the end of the period. So here, okay. Now to jump into the cash flow statement, again, I'm not going to spend too much time on the cash flow statement, but just understand that the cash flow statement is broken into three parts. The cash flow statement basically just shows the cash activity for a specific company on a given period of time, and it really focuses on cash that comes into the business and cash that goes out of the business. In terms of categories, you have your operating activities, which really focuses on the operations of the business. It takes into account the net income and also takes into account any changes in your working capital, right? Then you have the investing activity section, which takes into account, any types of investment that goes on into the business if they buy or sell any type of business. Also, any types of marketable securities, will get reported into your investing activity section. And lastly, you have the financing activity part of the cash flow statement, which really focuses on how the business finances its operations. Are they issuing equity via issuing shares, or are they financing via debt by issuing debt? Are they paying down the debt, or are they issuing dividends or buying back shares? All of that gets reflected on the financing activity section of the cash flow statement. And again, for those of you that are not familiar with the cash flow statement, I'll say that take some notes, review this recording, and just go online and do a simple Google search and get yourself familiarized, because you get a lot of questions in investment banking interviews or in equity research about the cash flow statement and how would you account for depreciation or your working capital or CapEx, right? In which section of the cash flow statement can you make any one of those adjustments? I'm not going to spend too much time on depreciation, deferred taxes. I'm going to skip through this. Working capital, this is very important. Working capital is basically a measure of liquidity for the business or operating efficiency, right? You can take your total current assets minus total current liabilities would equal to your working capital. When we're talking about total current assets, we're not including cash and cash equivalents or marketable securities. We're only including the part that associates with what has been taken on an accrual basis, like your accounts receivables, inventory, prepaid assets, other current assets, and the same thing goes for your liabilities, accounts payables, other current liabilities, and so forth. So these are some of the key line items, again, which I just mentioned. And then you also have, projected days. This formula right here just gives you an approximation of how long it takes a business to convert its current assets into cash or its current liabilities. So for example, if you have your accounts receivables, right? In this example, it's 2,500 divided by your revenue times 360 gives you 90 days. So this basically tells you how long it takes the business to convert its accounts receivables into cash. So it's typically around 90 days. And again, this is very, very important. And you will notice that with different business in different industries, this number is definitely going to vary, right? You may have some business that is in 4 days, may have some business that may be in 300 days. And those numbers can definitely formulate a story associated with the business model that you're analyzing. This is just the templates that we're going to be covering, and a lot of this stuff is going to make more sense once we jump into the model and you start seeing how we model those line items. The balance sheet. So basically your assets, is something that is going to have its resources of having economic value that is owned by a company in which it's expected to provide some future benefits, or it will help the business generate cash flow at the end of the period. These are some of the major line items in your current assets. More long-lived assets, right? You obviously have your property, plant, and equipment. You also have your goodwill. You may have also some intangible assets in there, but these are typically the core line items that you may find on the balance sheet. Not going to touch much on goodwill. We'll definitely cover this in the other modules, because there's a way of creating goodwill. Your liabilities, part of the balance sheet, right, are basically all of the debts and all of the obligations that the company has. On the current liabilities, you may find short-term debt, accounts payables, accrued liabilities, and then on non-current liabilities, you have more of the longer-term debt, like your longer-term bank debt notes, deferred taxes, and other outstanding loans. And then you have finally the shareholders' equity portion of the balance sheet, which basically shows what's been happening with most of his capital accounts, right? You have your share capital or your paid-in capital, which reflects, the capital that has been raised through issuing any shares. You have the retained earnings part of the balance sheet, which takes into account all of the earnings via your net income. You also have your treasury stock, which reflects all of the shares buyback that you have into the company. And, there's some other line items like minority interest may also be reflected in shareholders' equity. And I've noticed that GAAP has actually changed the rules where if you have minority interest, in the past you might have shown it under the liabilities part, but now they're showing it on the shareholders' equity part of the balance sheet. And in terms of modeling, and once you start building the model, there are two theories of modeling. One is that the balance sheet drives the cash flow statement, and the other one is the cash flow drives the balance sheet. Although they're both correct, the cash flow drives the balance sheet is more logical and efficient, right? You have cash coming in, you have cash coming out. Once you get that cash, then you could go ahead and adjust each line item that is corresponding in the balance sheet. And in terms of good practices and balancing techniques on the model, I guess I'll just skip through this and I'll touch on this one, right? This particular slide, because it summarizes the other three slides. Typically, when you're building a model, the most common errors that you may find is that, one, you may link to a wrong cell. Two, you may have the wrong sign. It may be a negative or a plus sign. That may be incorrect. Also, you may have the wrong formula in one of the cells. And these are the type of common mistakes that would not allow your balance sheet to balance. So it's very important that you understand, how to link to the proper cell. It's very important that you get the right formula when you're building the model. And it's also very important that you modeled out the first year correctly, because once you have that first year correctly, you're basically just going to project those same formulas into the future. So it's very important that you get that first year correctly. And then how to balance your model. I'm going to walk you through how do I actually balance the model by zeroing out my cash flow statement and adding individual line items to the cash flow statement to show by the amount that I don't balance on the balance sheet, and how I can definitely identify my mistake, whether it was a linking error or whether it's a formula error. So we'll definitely touch into that. And just to wrap the presentation, the final part is the debt schedule. The debt schedule basically just takes into account all of the debt obligations that the company has, longer term debt, or interest bearing debt that it has on its books, and just the pay down of that debt. The cash available that you have to service that debt, and how much you're paying down for a specific year, how much interest you're paying on that debt, and then at the end of the period, how much cash you have. So we're going to model that out in the debt schedule part of the model. So I guess I could switch my screen now to the model. Okay. So can most of you guys now see the Excel that I have open now?
Is this a good time to handle some questions?
Yeah.
And just for guys that have jumped on recently, just on the handout side of your dashboard, you can now download the model. We'll start to build it. Just a couple things people are asking about the slides. These slides are very crude, as you can see. These are actually handouts that we've decided to upload. These are not our core materials. We use textbooks. But yeah, they'll come with the presentation and everything, and this will be recorded. So some people, just a couple good questions. Somebody asked, isn't the depreciation on the income statement the same as on the cash flow statement? Not always. The cash flow statement, in our financial modeling projections, yes, we just, as a default assumption, assume whatever depreciation is reported on the income statement will be the same on the cash flow statement. But often, if you see a depreciation and amortization line in the income statement, it might not be that, if you do see it on these, it might not match exactly the number on the cash flow statement historically. And that's because there might be some other types of amortization, for example, that are tax deductible, but the cash impacts of that are a little bit different. So, that doesn't really impact the way we project things, but just something to be aware of. Again, it's tough to get into more detail about that without kind of going through the textbooks. Somebody else asked, EBITDA proxy for cash flow, we talked about that. Oh, AR, Luis, I think you just didn't mention AR. In the example that we used about trying to illustrate the impact of revenue, and some portion of revenue is received in cash and another portion is received on credit, a couple of people asked, just one thing to note, this doesn't mean like Walmart paying with a credit card. If a customer pays with a credit card, that doesn't mean that's on credit. If a customer pays something with a credit card, the company would actually receive that in cash. The credit card is, and all those receivables are held at the bank who owns that credit card. So when we say a customer paying on credit, this is a different type of credit than just a credit card, and that receipt on credit is in fact accounts receivable. So I think a couple people had questions about that, and then somebody else said, why do you add back depreciation in cash flow? And we didn't get into too much detail. I think Luis briefly mentioned. I mean, the whole point, just to reiterate, of cash flow from operations is to add back anything from the income statement. I mean, this is the foundation. There's more to this, of course. Add back anything from the income statement that is non-cash. And depreciation is an accounting method or as a method to account for the aging of assets. It's not actually a cash expense. You don't actually write a check for depreciation to anybody. So this is definitely something that you always add back. So I think that handles most of the questions, Luis. And again, that was just, what, 20, 23 minutes to go over materials that we spend, typically 1 or 2 weeks on in our school. So really broad, and the whole point is really just to kind of give you a high level to be able to start talking about things in interviews, etc. Okay, Luis, I'll switch it back to you.
Okay, and just to add, my own side note on this is a lot of the things that we're touching or that I touched on in the presentations, are basic accounting principles that you typically will learn, in Accounting 101, Accounting 102, and I understand that a lot of you guys are in different stages, right? Some of you guys might have taken accounting, and some of you guys might have taken finance courses. For those of you that have not, again, go to Google, do a simple Google search, come and visit our classes, come and sit in one of our classes so you could see how we actually teach, accounting, and even the textbook that we use in class, we can definitely show you guys and guide you and give you a broad explanation of what it is, and even get very detailed into that. So, just try to bear on and follow along here, because now when we jump into the modeling part, for those of you that understand this, great. For those of you that this is new, just try to follow along. If you have questions, try to type it. But at the end of the series, what I would recommend is go back and spend some time reviewing this material. So go to our website and go and look at all the previous recording sessions that Paul has posted on YouTube. So with that being said, I'm going to basically just jump into this.
Yeah, Luis, sorry. Just continue checking YouTube and Twitter on my accounts. I always post our classes here and there. You guys can always, email one of or call one of us and say, can I sit in on one of our classes? And you can always do that. And also, the last time I checked WorldCat, at least the first book is in 343 libraries worldwide. So take a look at your university library or your local library and just check to see. You can go on worldcat.com, which shows where the books are. You might be able to just get the book for free. So just other resources that might be available to you to learn this stuff. Okay.
All right, good. All right, so this is basically the template that most of you guys already, I think, downloaded this. But this is what a core income statement looks like, right? And obviously, some business may have different income statements, that they may look differently because they may have different line items, and they're in a total different industry, so the business is different, and the way they may record and the type of expenses they may have may be a little bit different, just because of the business model and the way it's associated. Generally, when I am going to build a model on a specific company, I will tend to go to the SEC, especially if it's a public company. I will go to the SEC, I'll pull up their 10K, and I'll see the structure of their financials. And then I'll definitely just copy all those line items, and then I start modifying it based on what I think needs to be modified. Then I'll start adding, revenue growth, margins, EBITDA, any one-time adjustments, line items. So that way you could basically start constructing the core of the income statement. So the first thing we're going to do here is lay out the historicals, right? 3 years historicals. And the reason why we do this is we want to be able to understand and look at the story, because every business has a story, and Wall Street's really a story. If you're going to go to an interview, you're going to present yourself, you're going to talk about your story, you're going to speak about your background, and you want to make the story obviously to be compelling, you want it to be exciting, and you want it to stick and have a few bullet points or have a couple of major points in there that stick and people remember. It's the same thing with a business, right? Is it a growing story? Is it a business that is under restructuring? Or is it a business that is declining, right? What's the story? And that's what historicals is able to give us. And if we have more information, obviously we could go to the company's website, we could look at the news, we could read the SEC filings, the 10Ks and 10Qs, just to get a lot more transparency and a lot more of the story of the business, what's been happening. So what I'm going to do here, I'm going to lay out my historicals and calculate basically my net income and earnings per share. So notice at the top line, we have price and volume. This is a very simple revenue buildup for this company. So what I'm going to do is I'm going to take my price, which is $20, and I'm going to multiply by my volume. But before I do any of this, I just want to lay out some basic formulas, right? I want to lay out my price growth, by how much has price been growing year over year. And this is fundamentally the right way of doing it in terms of formula, right? You take your first year divided by your previous year minus 1. And this basically gives you the growth rate of price year over year. I'm going to add decimal places here just to see the changes. And I'm going to do the same thing for volume. And we notice that volume is basically what has been growing for the past 3 years at a 10% growth rate. I'm going to do the same thing for total revenue. Okay, and this is basically, it may be a little tedious if you're building a financial model, or when you're in investment banking, you're an analyst to be doing this. But as City has been seeing, it's also very important that you get this step correctly, get the right formula. But you have to spend time in understanding what's going on with the numbers, because a lot of time when you're an analyst and you're modeling, you get too focused on the numbers because you're reading through 10Ks, you're dealing with spreadsheets all the time, that you lose sight of the bigger picture, and which is, okay, what are the numbers telling you? How do you interpret the numbers? And what's the message? What's the number that the numbers is releasing? So right here, in terms of cost of goods sold, in terms of margins, we take our cost of goods sold divided by total revenue, and it basically gives us our margin. And gross profit is total revenue minus cost of goods sold. Gross profit margin is your gross profit over total revenue. And we basically see that, this is a fairly profitable business, good profit margin, 75%. We look at the margins for our operating expenses, R&D. We do the same thing for SG&A. And we calculate our total operating expenses. We have other income, in this case, equity and earnings and unconsolidated affiliates. This can also be joint ventures income that you may find on the income statement. So my EBITDA is going to be my gross profit margin less my operating expenses, plus or minus equity in other affiliates. Okay, so now we have our EBITDA, and what's our EBITDA margin? 54%. So it's a pretty profitable business. I mean, we have basically 53.5% in margin. So for every dollar that we generate in terms of business after expenses, we can kind of expect that we're going to keep 50 cents. We might generate 50 cents in cash, basically. We have our depreciation amortization. So we subtract depreciation amortization from our EBITDA. We get EBIT, or operating income. We calculate margins. And it's 47.5 actually. We have interest expense, interest income, calculate our net interest expense, and then we subtract our interest from our EBIT, and gives us our income before taxes. And then we calculate our margins. Most of our margins, or all of our margins, are as a percentage of revenue. Income tax expense, in this case, was $16.50. To calculate our effective tax rate, we basically divide our current tax over our pre-tax income. Typically you could look at a company's 10K and 10Q just to see what their effective tax rate is. Typically they'll give you that, especially if you're going to forecast and you want to see what they've been paying. We subtract our taxes from our pre-tax income, and we get net income from continuing operations. And notice the type of line items that are associated with non-recurring events. You have discontinued operations. This means that they probably sold off or spin off one of their business lines. Extraordinary items. This may be something associated with a fire that might happen to some of their stores and they lost money for that. May occur like a flood. Anything. I like to say that anything associated with natural causes or natural disasters may be included in extraordinary items. Any changes in accounting effects, and then other line items. Take the net of this, and then we will subtract all of our total non-recurring items from our net income from continuing operations, and we end up getting our net income. Now we're going to make some other adjustments. We have net income attributed to minority interest. So in this case is 0. We don't have any minority shareholders. The percentage of net income that's paid out to minority shareholders right now is 0 because obviously we're not paying anyone out. In terms of dividends, we pay out 8 cents a share to our shareholders. So we're going to take our 8 cents a share times our basic shareholders, and we're going to divide this by 1,000 because our shareholders are in actual figures. So these are in actual. So this is our millions, and our financial statements figures are in thousands. So we adjust our net income by subtracting our minority interest, and we subtract our dividends, and we get our net income after dividends and minority interest expense. In some cases, you may find this in a 10K. Sometimes they may lay it out this way. Sometimes they may not lay it out this way. Again, it's really a preference depending on how management or the CFO of the company presents its financial statements. And finally, we'll calculate our earnings per share, which we're going to take our net income, not net income after dividends and minority interest, right? We're going to take our net income that is available to our shareholders, the basic, and I'm going to divide this again by 1,000. And there we go. Scroll this down. Now we have our earnings per share, right? So this business is basically generating $3.05 on the basic level, and then $2.03 on the diluted level. For valuation purposes, I usually focus a lot more on the basic number when I'm looking at my PE multiples. Some people may do diluted. To be quite honest, if there's not really a major difference between both earnings per share figures, then you could take the basic. But if there is, like in this particular case, you may want to also consider looking at the PE multiples on a diluted basis, right? And try to understand how is the market valuing this business if you're looking at PE multiples. Are they doing it on a basic basis, or are they doing it on a diluted basis? And pretty often you can find the answer by just calculating both PE multiples and looking at the company's comparables. But we've now laid out the first years of our historicals, and modeling purpose, I'm just going to drag to the right. For those of you that are following along and have questions on the shortcuts, you could easily do a Google search for Excel shortcuts, and you could identify what I'm doing. I'm just basically highlighting my previous year, holding Shift and moving to the right side, and then doing Control R. So I'm basically copying only the formulas to the right side. Okay. So now that we've laid out the 3 years historical for this business, we could basically see that this business has been growing steadily for the past 3 years, at a 10% rate. Margins are very stable, right? Let's look at our EBITDA. Our EBITDA figures, it's pretty stable EBITDA. So we could basically draw the conclusion that it's a business that's been growing consistently with consistent EBITDA margins, and it's pretty profitable. And obviously, these numbers is reflecting that. And they're going to play it into how we're going to forecast the business going forward, right? So in terms of modeling the future, which is this part right here, we take certain judgment calls into considerations. On Wall Street, again, when we're in investment banking, typically we use Wall Street consensus to really project our drivers, which would be our year-over-year price growth, our volume growth, and our margins. Typically we'll take Wall Street consensus. Unless you're an analyst covering the company, if you're on the buy side, you will make your own judgment and you will create your own assumptions. The hardest part to building a model, it's really this part right here, coming up with the assumptions. The other parts, are more technical, right? Forecasting revenues, linking the balance sheet to the cash flow statement. How do you calculate EBITDA, or how do you calculate your working capital? These are just simple formulas that you should familiarize and remember. So it's really the technical part of the model. The hard part is really the assumptions that you're bringing in. And
Hey, Luis.
yeah.
Couple things. Some people are asking if you can go a little bit slower, and
Okay.
so just judge the pace. And for you guys, we are recording this, so absolutely you can kind of go back and review, and that's the point. It's tough in webcast mode, but we're just trying to get a lot in a few days to be informative. But yeah, that'd be good. A couple other people asked with respect to G&A and R&D. I don't know, Luis, if you answered. How do you determine whether it should be projected as a percentage of revenue versus year-over-year growth? I don't know if you want to address that. Go ahead.
Okay, so again, what I was basically discussing, that's really the hard part. How do we project our expenses, right? We usually do this stuff as a percentage of revenue, right? We look at the margins. We look at historically what the margins have been, and then we'll make our own assumptions, right? And how do we make these assumptions? Well, we could listen to we could read management presentations. We could listen to the earnings calls to see how management is projecting the business. We could read the 10Ks and the 10Qs to see what type of major expenses may happen in the business, and if any of those major expenses may associate with their operating expenses or their cost of goods sold. If they don't mention nothing that it's major, that is going to affect the business and it's really going to change the fundamental aspects of them, then we could basically just assume that most of these numbers will stay consistent. So we would just basically either flatline these numbers or we will hard code them, consistent with how the business have been performing on a historical basis, right? But past performances may not be, indicative of future performances. That's why you have to understand the business and be able to see, is this the same company that's going to perform the same over the next 5 years, right? Is it going to look the same? So let's start line by line here, and hopefully this would touch on the same question again. So in terms of price, right, the formula to project going forward is going to be the previous year times, open parentheses, 1 plus your growth rate, right? In this case, by how much are we going to grow price, and then close parentheses. So we're going to make the assumption that price is going to grow at the rate of inflation, right? So let's say inflation is 2%. So we see here how price is going to grow by 2%. Let's look at volume, right? Over the past couple of years, volume has been growing at 10%. So after reviewing management presentation, after reading the 10K and listening to their earnings, and also reading some Wall Street analyst research reports, we're going to assume that they're going to continue to grow volume at 10% over the next 5 or 6 years, right? So we're going to do the same formula, previous year times, open parentheses, 1 plus my growth rate, close parentheses, okay? So once we have the revenue top lines forecast, from a modeling perspective, we could easily just copy the previous year formula and just drag it to the right. And it's the same thing, right? Price times volume. The margins or revenue year-over-year growth, the formula basically just gets copied over for the previous year. And notice how I'm Right now, I'm only forecasting my first year. I'm trying to get the first year correctly, because what we're going to do later is we're able to drag it to the right and populate the other years. So for cost of goods sold, we notice that margin again has been consistent. We've done our due diligence analysis. We've read research reports. We looked at the 10K, and we're going to assume that margins are going to stay in line with historicals, and I am going to keep it at 25%. So I'm going to
Luis,
multiply
can I
my.
make a comment on that while
Yeah.
you're doing that?
Mm-hmm.
Just in terms of these core expenses, I think the most basic way to look at it, and again, if we had more time, we typically dig into this in more detail, but there are fixed expenses and there are variable expenses, right? Variable expenses are the expenses vary in line with the amount of units produced, right? So in this example with revenue, we have in cell G8 665.5 units being produced, and the price at 2% is $20.04. So if the volume would increase, then we're assuming the cost of goods sold would increase accordingly, right? Because the cost of goods sold is the cost of the units that are being sold, the production cost of the units being sold. And an operating expense, however, if that expense was like rent, for example, where rent might not increase just because you're selling more product. Rent might just increase, like let's say your apartment rent at 5% a year. You might not want to project that as a percentage of revenue. You might want to project that as a year-over-year growth. So to answer the question before about how do you know whether it's year-over-year growth or a percentage of revenue, you have to really, to Luis's point, look into what the line item is doing and saying. Now, if you're modeling a big Fortune 500 company, usually you don't get into that detail. If you're doing like an LBO analysis where you're getting into line by line by line, then you can get into that detail. You can look at like rents and salaries and say, well, that might not grow, based on units of production. But in a Fortune 500 company, you usually have like 2 or 3 major line items, and because they're so big, usually by default you always look at these expenses as a percentage of revenue. Some of these other line items that Luis had mentioned, you might want to keep them flat, things like that. We'll see this a lot in the cash flow statement. There's a lot of kind of one-off line items that are labeled as other, other costs based on XYZ. And it's very difficult for analysts to project these things. We won't get into it, I don't think, but in the book we have a seven methods of projecting these line items. How do you take a look at these line items, and given some basic research, how do you narrow down using these 7 methods to hone in on projecting those with a little bit more accuracy than just saying, all right, keep them flat. So this is just to the point of, in this series, we can't get into every single detail, but you can supplement them with the books. And again, I always recommend breaking into Wall Street's kind of series of modules as well to get into more detail.
Okay. All right, good. So to calculate our cost of goods sold, again, we'll multiply our margin. If we're, in this case, we're going to flatline it, times our total revenue. And then we just drag our previous year formula to the right. With operating expenses, R&D, SG&A, again, you could definitely have your own judgment on this by doing your own due diligence, or you could use Wall Street estimates and try to get your EBITDA to match Wall Street consensus. So by doing that, then you could adjust your R&D and your SG&A more accurately, if you will. So for now, I'm just basically going to keep this at 9%. I'm just going to flatline this and make it 9%. And my SG&A, I'm going to do 12.8. I'm just going to look at the last year. And I'm going to take my R&D margins times my revenue, and the same thing for SG&A times revenue. Other, I'm going to keep it flat. I'm going to keep it 0. My total operating expenses, same formula. I could just drag it over. Equity and earnings and affiliated, I'm going to keep it 0. And my EBITDA margin, I am going to drag it across, and we could basically see our EBITDA. So at this point, our EBITDA margin is still consistent with the previous year. One thing to do a sanity check when you're reviewing your own models is to look at your margins, right? Look at your EBITDA margins, look at your EBIT margins, and make sure that they're in line. You don't want to see something where, we have 53, the past 3 years, and then all of a sudden in this 1 year you have, let's see, you have 16, because you might have done a typo somewhere in your assumptions or in the formula. This is a red flag. This is where you want to go back and see, okay, what have you changed in your model to cause this drastic decline in your EBITDA margin? So in this case, it was my SG&A, which I basically changed. So I'm just going to undo this. And you want to see consistency. Our depreciation and amortization, for now, I'm just going to highlight this because I am going to model this out in our depreciation schedule, and then I'm going to link it here, right? For now, I'm just trying to get the core structure of my income statement put together. My EBIT, I'm going to drag it over. Same thing with my interest expense and interest income. I'm going to highlight this because, again, we're going to link this later on because we have to model out our debt schedule, which we're going to do later on. The only thing I could do for now is just basically drag the formulas that I have from the previous years. My income tax, I'm going to make this 35%. I could basically notice out of the past 3 years, it's basically been 35%. So I'm just going to keep this constant. Multiply 35% times my income before taxes. And I'm going to drag the formula. I have my income from continuing operations. Non-recurring events. Typically, if you have non-recurring events, you'll make those adjustments and you'll see that here. But going forward, this line item, you do not forecast. You keep it at 0, okay? Now I have my net income. In this case, for minority interest, so we don't have any minority interest shareholders, so I'm just going to make whatever portion we pay out of our income, of our net income to our minority shareholders, I'm just going to keep it at 0. And to forecast this, I'm going to do the minority portion times my net income. So whatever portion would be allocated to them, I'm just going to multiply by my net income. So far it's 0. My dividends, we could still see that they've been paying 8 cents a share over the past 3 years. So we're going to keep this consistent. So I'm just going to link to the previous year. I could either link to the previous year or I could either hard code it. It's really up to you. It's a modeling preference. One thing that I didn't touch on from the beginning of the modeling, right now I'm basically linking this particular cell, so it has to be green. So any links is green, right? So right here I have my legend. Hard codes are usually blue, or they're basically blue. Links are green, so any links to any other cells are green. My formulas are black, so you can see here that any cell that has a formula is basically black, and any external links or links to any other sheets are red, right? This is pretty standard, across Wall Street, so it's very important that you keep your models consistent with the standard because it's easier for an analyst or for an associate, if you're an intern, to audit your model, right? If I want to come here and see what are your drivers, I expect your drivers to be in blue. Versus seeing your drivers in black or in green, then I'm going to automatically assume that your model is wrong. Because if you didn't have the time to lay out the simplest thing of coloring your cells correctly, I'm going to assume that you didn't take the time to review your formulas or link to the proper cells. So right off the bat, I'm going to assume your model is incorrect. And this is the standard and the level of scrutiny that an analyst or an associate will review your model if you're an intern. And in a lot of cases, this is why we don't trust interns, or we don't let interns build models for this exact same reason. So you want to make sure that you have the right habits when you're building a model. So my shares outstanding, I'm going to just flatline this. Okay. So my dividends, I'm just going to copy the formula. It's still 80,000. Net income after dividends and minority interest expense. Just going to copy this across, and then I'm just going to copy my earnings per share formula. So after we forecast the first year, right, if you do the first year correctly, the beautiful thing about Excel is that you could select the entire column, right, of that first year that we're forecasting, in this case 2012, and we could just easily shift everything to the right, especially the years that we're going to forecast, and then do Control R. And look at that. It copies the formulas, it copies our assumptions, any links that we've made, it just copies it all across to the other years. And I'm just going to separate my historicals from my actual estimate numbers. And there. So this is simply, the easiest part of the net income. The last part of this series, to finalize the model, I will add a scenarios tab to this template where we could run several scenarios. And then based on those scenarios, we could see how the assumptions change, how the EBITDA margins change for this particular company. But for now, we're just going to flatline all of our assumptions. Okay? So I don't know if this is a good time just to pause here and see if anyone has any questions on the net income, because the next step on this is going to be projecting the depreciation and amortization schedule, and then projecting the working capital schedule. So does anyone has any questions that we should be answering at this point, Paul?
The only one that's kind of popped up is about why you're not using the average as opposed to last year. And again, I'm just going to kind of reiterate, and Luis, you did touch on it. There are several methods, and in the book we detail several common methods and how to narrow it down. I personally do not think averaging the last 3 years, although analysts do it all the time, is indicative of next year's performance. Especially in this example, and I realize that this model is a little dated. I should have updated it. 2009 was such an exceptional year. Averaging that in wouldn't tell us what last year's performance is better indicative of next year's performance. But it depends on the perspective, the timeline, and you got to take all these things into consideration. So, there are several ways to do it. And in a good model, which we won't get to in this series, but in a good model, you would have a scenarios tab with a conservative case, an average case, and an upside case that you can toggle between all these 3 different scenarios if to show varying perspectives.
Yeah. Okay, and just to add, from my experience, I honestly, yes, some people may take the average. I've never taken the average, and honestly, from my perspective, that's probably the lazy approach, because you're just taking last 3 years average, and you're not really doing your due diligence. You're really not reading estimates, listening to the earnings calls, reading industry reports to really try to make the most accurate projection possible on what your margins are going to be. It's okay if you have a very mature company like a Walmart to do that, or like a GE, the big conglomerate companies that are only growing at like 1 or 2% year over year. It's probably okay to do that. But when you're doing it for a mature, for a young or middle market company that is growing, and revenues are going to be volatile, the margins are going to be volatile, you simply can't do that. You have to be able to do your due diligence and put a lot of more time and thought process into coming up with margins. Because honestly, if I'm on the buy side as a security analyst and I'm interviewing you and you say you're forecasting just using past 3 years average, I'm going to grill you on that. In terms of the market size, is the market size the same 3 years ago? Is that going to be the same 5 years out? What about the competitors, right? Is your company facing increased competition? And for that, are they going to cut into your market share, right? If that's the case, your margins are not going to be the same. So for now, I'm just going to flatline it, but keep that in mind in terms of doing your due diligence and having a lot more of an analytical, more thorough thought process when you're trying to do your margins. And again, this is really the hard part of building the model. It's really coming up with accurate projections. This is exactly what makes the market. Analysts may have more aggressive assumptions than others. Some analysts may have a higher valuation than others because of these assumptions. And at the end of the day, that's what makes the market. That's why companies trade at different multiples. That's why the market goes up and down. A lot of it is because of this. So next step, I'm going to forecast the depreciation schedule. So we have two lines here, or two things to really model that. You have your book depreciation, right? Your straight line book depreciation, and then you have the accelerated method of depreciation. The reason why we have both is because some companies may have deferred taxes, and for cash purposes, if they want to keep more cash on their books, they can select to use an accelerated method for tax purposes and increase the depreciation amount that they're paying, which is going to reduce your income before tax payments. And based on that, you're going to pay less taxes. But however, that tax that you're going to be saving is going to be deferred for later years. So if a company is going through a cash crunch and they need extra cash, they can use this method to just raise some cash in the current time being. So what are we depreciating? What we're depreciating are PP&E. Our PP&E in this case is coming from our balance sheet. So I'm going to change the color of this red because it's coming from another sheet. And we could see here that it's coming from this line item on my balance sheet, okay? And we also have our CapEx. Now, in terms of depreciation, we're going to assume that our total assets get depreciated, or they're basically going to last 10 years. Typically, again, this assumption right here, you will read the 10K or the 10Q to see what is the remaining life on the property, plant, and equipment that business have. It may be 7 years, it may be 20 years, right? You have to look at the 10K or the 10Q to see what that number is, and then you could definitely hard code that that number here in your depreciation schedule. So on a straight line method, I'm going to take my total PP&E and I'm going to divide it by my years, and I'm going to anchor this, and I'm going to drag to the right. So again, this is just basically your simple straight line depreciation where you're evenly depreciating the same amount for the next 10 years, right? Now, because we have depreciation, right? Depreciation takes into account the aging of your PP&E. Well, we have to replace that depreciation, meaning we have to reinvest into the business, right? We have to maintain our plants and our property and all of our equipment, because sometimes our plants, any manufacturer that they have repairments going on, or they have parts that need to be replaced. All of that gets into account here under your capital expenditures. So I'm going to take my CapEx amount, and I'm also going to divide it by the same remaining years of my PP&E. And I'm going to anchor my CapEx, and I'm going to drag across 2015, right? Now I'm going to do the same thing for CapEx under 2016. I'm going to take my CapEx, divide it by my year. I'm going to anchor the CapEx amount, drag across. So I basically do this for each of the years that I have here for CapEx. Okay, so I do the same thing for 2017. And what this essentially is doing is creating a waterfall. So for those of you that have heard of the term, a depreciation waterfall, this is basically what it is. just gonna change this. And this year. And my final year. There we go. Just want to do a little sanity check. My final year. Okay. And we basically just take the sum of my waterfall, if you will. And this is basically my book depreciation. This is a depreciation that we basically link to our income statement. So right now, I'm going to go back to my income statement and I'm going to link to my book depreciation. I'm going to turn this red because it's an external link. It's linking to another cell. And now we could basically see our EBITDA margins, our EBIT margins, right? It's still consistent with the past 3 years. The reason why it has increased is because of our assumptions to increase our price based on the rate of inflation. Okay? So I'm going to go back to the depreciation schedule. The other thing I like to do, and again, this is for sanity check, I want to compare my depreciation as a percentage of revenue historically. So I'm going to link my depreciation for the past 3 years, and I'm going to calculate this as a percentage of revenue. So I'm just going to modify this template a little bit. I'm going to add my revenues here. I'm going to type revenues. Right? And I'm going to link my revenues. And the reason again why we do this is just for sanity check, right? We don't want to we don't want to see a change in our depreciation margins, going from 5% to 20% from 1 year to the next. This is very important because if you do that later on when you're doing your DCF analysis, you're going to overstate your depreciation amortization, and therefore you may overvalue the business by simply overstating your depreciation and amortization. Okay, so that's very important to remember. Okay, so we see that over the past 3 years, our book depreciation as a percentage of revenue has been consistent, 6%, right? So what is it going forward? 4.2, 4, 4, okay. So it's declining. The reason why it's declining, part of it has to deal with our CapEx, right? Look at our CapEx. In this case, our CapEx is fluctuating significantly, right? And again, just for training and modeling purposes, these are all dummy numbers. But when we're dealing, if we were dealing with an actual company, we will not see this type of variation unless management specifies that this is the variation that we're going to have. Or some businesses, depending on the business cycle, they may also have this. But when you're dealing with very mature, very consistent companies, you're going to see very consistent CapEx. And you could easily just do CapEx as a percentage of revenue, see what the margins are historically, and you can make the assumption that that's what it's going to be, and then you could flatline whatever margins has been historically. You could flatline that going forward. So for this case, for training purposes, we're going to leave it as is right now. Later on, we may come back and change this assumption just to make our book depreciation consistent with our historical book depreciation. Okay. Again, this is very, very important for you guys to understand, especially when you're modeling. So the next step in our depreciation schedule is to calculate the accelerated depreciation so that we could come up with our deferred tax. So we have our assumptions here, and notice that in the earlier years, our depreciation percentages is much higher than later years. And again, typically this table right here, you will have a maker's mark table. You could go to the IRS. You could see what the IRS is saying you could depreciate for that specific industry, and they'll give you the table, they'll give you the rate, and you could easily come here and change these numbers based on what the IRS allows you to depreciate, depending on the industry that the company's in. So we're going to depreciate our existing PP&E. So I'm going to take my PP&E times my existing PP&E depreciation rate. I'm going to anchor this. And I'm going to drag to the right. And notice how in the earlier years is higher than later years. I'm going to take now my CapEx and multiply it by the same rate, or the CapEx depreciation rate. I'm going to anchor my CapEx, and I'm going to drag to the right. Just double checking my formulas. I'm going to do the same thing for 2016. I'm going to take the 2016 CapEx time my 2016 accelerated depreciation rate, and I'm going to anchor my CapEx and drag to the right. And notice how I'm double checking my formulas. Notice how I'm doing F2, right? This is very important that you do this, because sometimes you may miss the row where you're supposed to be linking. You may link again to the incorrect cell. So this is just one way of double checking. And typically, after being an analyst, in my analyst days when I was at Credit Suisse, I would work 100-hour work weeks, building very complex financial models. And earlier on, I learned to do things correctly at the beginning, because if you don't, your model is not going to balance. And if it doesn't balance, you're going to end up spending, those late nights in the office trying to figure out why it doesn't balance when you have a due deadline early in the morning at 10 or 9 a.m. And those are the reasons why analysts sometimes get stuck in the office. So I'm going to take 2018 and do the same thing. And right now, this is just repeating the formula, so I'm just going to speed up a bit just to gain some time, and we could touch on other important topics and spend more time discussing that. And there, so I'm just going to double check this. See, here's an easy mistake. Notice that this cell is wrong, and so is this. So this is one that I have to definitely double check and fix. This is why you double check your formulas, guys. There. It's pretty bad if my associate discovers that mistake, right? When I get my final year review, they'll probably say I don't pay attention to detail, right? You'll probably say I don't take time to review my work. That's not what you want to see in a top performing analyst. So here you go. So now we see our total tax depreciation. Now to calculate the difference, right? We take the accelerated depreciation, which is what we can use for tax purposes, minus our book depreciation, which is the amount we show on the net income for GAAP purposes. The difference between those two basically generates a depreciation difference, which is basically a tax difference. We link our tax rate from the income statement right? And then we take that difference and multiply by a tax rate. And this is the deferred tax. This is essentially the tax saving for that particular year, right? And this is essentially what will later on have to be on the balance sheet. Once it gets to the point that it's negative, it's pretty much we kind of have, used up most of the accelerated method. And past this point, you're probably going to have to start paying back the taxes that you've deferred in earlier years. You're going to have to pay that back at some point. So now that we've completed the depreciation schedule, right, we go on to the working capital schedule. So again, just to recap what we've done so far. We forecasted our net income. That was step one. Step two was to project out and calculate our book depreciation and our deferred taxes. Now for step 3, we're going to go into the working capital schedule, right? And after this step, then we could go back to our income statement, double check this, make sure we haven't missed anything. And after our working capital schedule, we can easily start focusing on the cash flow statement and then focusing on the balance sheet. Because the working capital schedule, all it's taking into account is your current assets and current liabilities. These are very, very important things to notice, because if a company has any issues or any operating, any working capital efficiency, it will be a positive number. If they may be faced with any short-term liquidity issues, we could easily recognize that by seeing that your net working capital is negative, right? And in most cases, when that's the case, you may have a company that may be having poor operations, the stock price may suffer from that, or in some cases, it may be because of the industry, that depending on the industry, you also have to take that into account. Paul, before I start into the working capital schedule, is there any question, anything that we should touch on from what people have been typing? Nope. Okay. So for my working capital, I'm going to make some slight modifications here to this sheet, and this is just to make it a little bit simpler for us to model out. Because remember, from the earlier presentation that I showed you guys, each and every one of these line items, right? It's on a accrual basis that it's related to the income statement, right? You have our accrued expense and you have non-cash expense. So in this case, we have revenue, right? Which revenue associates with what? With your accounts receivables. We have our cost of goods sold, which associates with what? With your accounts payables. You have your SG&A expense, which associates to our accrual salaries and employee benefits. And then we have our year's days, which is what we're going to use to essentially model all this stuff out. So I'm just going to make a quick link here. And again, some of you guys, may ask, because I get this a lot in terms of the speed that I'm working on right now. Again, when you spend a lot of hours in investment banking, you really get used to being very quick and efficient, just because of the number of projects that you are working in, and you have to meet deadlines and you have to find ways to really increase your speed just to save time. And these are things that you only develop with time and practice. And lastly, my days in years. So days in years, just going to add a column here. This 5 days in years. I'm going to make this 365. We have 365. Some may use 360. It really depends on your judgment, right? I usually like to do 365 all years in the calendar year. Some people may use 360 again. It's just really a preference thing. Okay. So for my accounts receivables, right? And again, these numbers right here are coming from my balance sheet, and I should actually link to the balance sheet just to stay consistent. And you guys have an understanding where these numbers are coming from. My inventory, right? See, they match my inventory, so I'm just going to cut this. My prepaid expense, notice how they match, so I'm just going to cut that. And then my current assets. There. So all of these figures, again, they're coming from my current assets on the balance sheet. Now, notice that for working capital, right? I'm not taking my cash and cash equivalents, or in any other case, in any other event, if we had marketable securities. The reason why for this working capital we don't take cash is because working capital in this case is associated with the line items that are on accrual basis on our net income. If we were to include cash, cash is not really on an accrual basis, is it? Cash is what we have generated for that particular year. So cash is not, how can I say it? It's not a resource that is going to be converted into cash at a given point, right? Cash is already cash. Accounts receivables, inventory, prepaid expenses, this have economic value that at some point will be converted into cash. Same thing with current liabilities. At some point, this is going to be paid out, right? So it's going to be a cash outflow. So this is why we don't include our current cash in our working capital assumptions. Just going to link my liabilities real quick. And this number, and lastly, our total current liabilities. All right, so the first step to figuring out our working capital schedule is calculating the days. So we're going to take our accounts receivables divided by our total revenues times our days in a year, 365 in this case. And we notice it is 43.8. Drag this across, and we basically see how long it takes this particular business to convert its accounts receivables into cash. We do the same thing for inventory. How long does it take this company to get rid of the inventory they either have on the shelf or they have on the warehouse? Around 35 days in this case. And we do the same thing for prepaid expenses. And in this case, again, it's around 30. And we're going to calculate our total current assets. If we had other current assets, if we had a number here, typically we could do total current assets as a percentage of revenue. Okay, so for those of you that have questions about other current assets, you could do this as a percentage of revenue. And here we go, we have our total current assets. For current liabilities, we do the same thing. We calculate our turnover days for accounts payable. In other words, how long does it take for us to pay our creditors? So we take accounts payable divided by cost of goods sold times our days in the year. So notice how we've been getting a lot more efficient. We've been paying in less days, 17. We do the same thing for our accrued salaries and employee benefits as a percent of SG&A. Okay, so it typically takes us about a month to pay all of our employees, whatever it is that we owe them in terms of payroll. Other current liabilities, if we had a number here, we could do this as a percentage of revenue as well. Let's take the total of this. And my total operating working capital is total current assets minus total current liabilities. And here we notice it's a positive number. So is this business facing short-term liquidity? No. I mean, they could easily cover all of their current assets because they have more, they could easily cover their total current liabilities because they have more total current assets. And to project our accounts receivables, we're going to look at the days. We're going to just flatline. It says 45.2. I'm just going to round it and flatline it and keep it 45. Inventory, same thing. Notice the final year was 35.4. I'm just going to round and keep it at 35, and the same thing for prepaid expense. For my accounts payable, right here I have 20, but I noticed that for the final year, 17.3. Again, this is a judgment call. You may want to keep it at 20. You may want to keep it at 18. But I'm just going to keep consistent with the final year. I'm going to change this to 17, and I'm going to flatline the 17 number. For this payable, 40, I'm okay with that. I'm going to flatline it and keep it at 40. And to calculate accounts receivables, it's just working backwards now. I'm going to take my turnover days divided by my days in a year times my revenues, and it gives me my accounts receivables. Once you get the number correctly, you could drag to the right. If you have the formula correctly, you could easily just copy and just come in here and adjust the formula, because inventory is associated with cost of goods sold. And there is our inventory figure. Just gonna drag to the right. And lastly, we're gonna do it for our prepaid expenses and adjust for SG&A. And there you go. Now, for other current assets, I'm just going to keep the 0. And there is my total current assets. Now, how do you check for any mistakes or sanity check, right? If you come over here, just look at the previous 2 years, right? Notice that the number is ballpark. Your accounts receivables are in ballpark. Same thing with inventory and same thing with prepaid expense. What you don't want to see is where in your prepaid expenses, you accidentally change the number because you link accidentally to cost of goods sold, right? This is a huge increase. You're more than doubling your prepaid expense, right? If you were to calculate the revenue change, you may see that this is growing by over 100%. Sanity check right there. You have to come back and double check your numbers. Same thing with inventory, right? Let's say if you use accounts payable. Look at this huge difference, right? This doesn't make sense. So you have to double check your formula. Okay, so this is a quick and easy sanity check. We do the same thing for our accounts payables times our cost of goods sold. Notice that. And we're going to do the same thing for our accrued liabilities. And for my other current, I'm just going to flatline that and keep it 0. And here we have our total current liabilities. And now we have our total working capital. Now, to calculate the change in our working capital, we're going to take the previous year minus our current year. And this basically gives us a measure if there's a cash inflow or cash outflow for the business. And in this case, we're noticing that it's a cash outflow. And the reason for that, it's really because of our accounts receivables, right? And notice right here, I have a check. Right now, it doesn't match. It will match later on because this check right here, it's linking to our cash flow statement, which our cash flow statement, we haven't even populated our cash flow statement yet. But once we populate our cash flow statement, the actual change calculations in the working capital, from the working capital schedule, this will change and it'll definitely match. Let me just stop right here and see if anyone has any questions.
Yep. Yeah, a couple. One is, can you explain what prepaid expenses are and how is that affiliated with SG&A? I don't know if you want to address that.
Okay, so prepaid expenses are basically expenses that you've already paid in advance. It's an asset, it's kind of like something that you still haven't received in terms of a service provided. And how does it relate to SG&A? For example, you may pay bonuses in advance, or you may pay employees in advance for whatever cases. You could book that as an asset, as a prepaid expense, because you haven't received the actual performance or that service yet. I don't know if you have a different example of prepaid expenses, Paul?
I know, yeah, rent maybe. Sometimes you pay rent at the beginning of the month before it's expensed, and then it doesn't, so it's held as an asset until you actually exercise that expense and utilize it.
Yeah. I mean, it's like if you pay, your utilities, your utility bills, any type of administrative expense or overhead costs that you pay in advance, but you yet haven't received the total service for. And how does this relate to SG&A? Well, because in SG&A, we're definitely including our general and administrative expenses, which takes into account rent, utilities, insurance payments, all that good stuff.
Someone else asked about the dollar signs. I don't know, Luis, if you went through how to anchor the cells. You might have, I guess, did that in the depreciation schedule.
Um, oh, are they talking about anchoring this?
Yeah. Yes.
Okay, so when you're anchoring a cell, it basically allows you to just basically anchor that cell and drag to the right. For example, notice here how I'm anchoring this particular cell, but that the formula, I'm dragging it all the way across. So this is just to prevent me from having to retype the formula, 3 times. It's just something that it would allow you to save time. If you want to learn more about that, again, just do a simple Google search and learn how to anchor cells, and you'll get a lot more in-depth definition.
Yeah, it's in the books. We have an appendix in the back that has all the hotkeys, and you can find those online or the other modules as well. And there's a couple YouTube videos where I talk specifically about anchoring cells, so you can look at those.
Okay. Any other questions?
Some people talked about the changes in working capital. Are they negative? Are they positive? How do you differentiate
Yes.
between that?
Okay. Typically, we'll calculate that here in the cash flow statement, but I guess I'll calculate it here just for simplicity purposes and for the audience to understand. When you have negative working capital, it basically means that it's a cash outflow. It means that this amount of money or this amount of change is cash that you're not collecting because it's being deferred for a future point in time that you will collect it from your either customers, either from inventory or either from prepaid expenses. So I'm going to calculate the change right here for 2015, for example, right? So look at our accounts receivables. Notice that it's increasing from one year to the next. For 2014 to 2015, it's increasing. So to calculate the change, I'm going to do 2014 minus 2015. Notice that it's a negative number, right, in this cell. Let me highlight this so you guys could follow along. Notice that this is a negative number, right? The reason why it's a negative number is because if your accounts receivables increase, it means that you're increasing the amount for which you haven't collected from your customers. So for that year, you didn't receive 173,000 from your customers. So customers basically booked on credit 173,000. Your inventory is the same thing with inventory. You increase the inventory in your warehouse by 32,000. And just because the account on the current asset, just because it increases, it doesn't mean that you're actually getting cash for it. No, it works the other way around. It's cash that you don't increase, that you don't receive. We do the same thing for our prepaid expenses, and we do the same thing for our current assets. Now, for accounts payable, it's the other way around. We take our current year minus our previous year. And notice how it's a positive. It's 15,000 in this case. Because what is our current liabilities? It's things that we haven't yet paid for, right? So it's a cash savings. So when your accounts receivables or your current liabilities increase, it means that it's cash that you're actually saving. It's cash that you're deferring to pay at a later point in time. So when your accounts payables increase, it means that it's a cash inflow. When your accrued salaries increase, again, it means that it's a cash inflow. The change is positive. So we do the same formula here, 15.1, 15.4, and then our other current liabilities. So now we take the sum of all these changes from our current assets and current liabilities. We take the sum of all this and look at the number, minus 189.5, which is the exact same number that you see here. Why is it negative? It's negative because we haven't received more cash than what we've deferred from our current liabilities. I hope that basically explains the difference why is it negative and why is it positive. And again, this goes back to understanding the basics of accounting, understanding what accounts receivable are. When you draw on your T accounts, the difference between debits and credits. So I hope that it gives you a little more transparency and explanation.
And again, I do have separate modules on YouTube that go through this in detail. And then Luis, just to note, we're approaching 12. It might be a good stopping point. I don't know if you've linked this into the cash flow statement, but
yes.
Before you get into the balance sheet,
okay.
Stopping point.
So, so I guess for right now, just to wrap it up, I'll link to the cash flow statement, and then next week we can definitely complete the balance sheet and the working and the debt schedule, and link all this stuff together, and then just summarize everything we've done. So what we've done right now, okay, so we completed the working capital schedule. Now let's jump into our cash flow statement, right? I'm just going to calculate the changes or the sum formulas for each part of the cash flow statement. The operating activity section, the investing activity, and the financing activity section. So I'm just going to take the sum of all this, actually the sum of my working capital. And I'm going to take the sum plus my changes in my working capital plus the sum of all of my funds from operations, right? There. My investing activities, take the sum of all this. And my financing activity, I'm going to take the sum of all this. And my cash and cash equivalents, the total change in that is my operating activities plus my investing activities plus my financing activities. Okay, drag this to the right. And we'll calculate this at the end, supplement data, cash available before debt pay down. I'll touch on this later on once we have more time, because I can definitely explain a little more in detail what this means. So we'll leave that for the next session. I'm going to link my net income. And again, there's a difference. Notice how I'm linking my net income versus my net income after dividends and minority interest expense. Make sure you link to the net income before any dividends or before any minority expenses, because you can later adjust for that here in the financing activity section, and you don't want to double count the numbers. Okay, so now we have the historicals. So going forward, what have we completed up to this point? We've completed our income statement. So I'm going to link my net income. I've also completed my depreciation. So I'm going to link my depreciation. You can link it from the depreciation schedule, or you can link it from the net income. It's up to you. It's a personal preference. But for me, just to stay consistent where all the financial statements are linking with one another, I'm going to link it to the income statement. Intangibles amortization, we don't have any schedule. We really didn't model this out, so I'm going to leave it 0. Deferred taxes, I'm going to link this from our deferred tax in our depreciation schedule. Here we go. And now we have forecast our total funds from operations. Now, the working capital, the changes in working capital, the same formula that I walked you through over here is exactly the same formula that I'm going to calculate here. So this is a change in working capital. So our accounts receivables, it's going to be my 2014, my previous year minus my current year, right? Same thing for inventory. So for current assets, you could definitely maintain the same formula. And if you know how the rows are set up, you could easily just do control down, right? Just to make sure you can save some time, right? For my accounts payable, it's the other way around. I'm going to do my current year minus my previous year. And I'm going to do the same thing for accrued salaries. Okay, and I should take the net. So once I take the net amount of this, of my current working capital, this should match what I have in my working capital schedule. So let's see if this number right here matches what I have on my working capital schedule. Does it match? 89.5. What do we have? 89.5. So it does matches, but for whatever reason, I have a negative. If it's negative, it's because of a rounding issue. Or it may be the formula. So I'm just going to copy the formula. It does matches. So once we forecast all this stuff out, we should definitely match. Our CapEx, we have our CapEx because it's coming from our depreciation schedule. We have it right here. Make sure you insert this as a negative because CapEx is a cash outflow. I've seen this way too many times when I get an intern that has this as a positive number, and it's incorrect. Make sure you always have your negative sign for CapEx. I'm going to calculate the total formula here. For my financing activity section, we haven't done any of this, so we're going to forecast this later. So I'm going to highlight it. We do have dividends, right? We are paying out dividends. So I'm going to link the dividends pay down from my income statement right here. Again, for dividends pay down, make sure it's a negative sign because it's a cash outflow when we pay dividends. Minority shareholders, same thing. We could link to the income statement right here. And, make sure it's a negative sign as well. And other, I'm just going to keep it at 0. Take the sum of that. We have our total financing activities. And we take the formulas from previous year and calculating our change. So let's see here. See here, we haven't calculated this. Total funds from operations. So now we have the total change from the previous year. And notice it's kind of consistent, right, with the previous year. See, our cash flow is a little bit consistent, okay? It's a growing business. So what we're going to do now is same thing that we did with the net income statement, right? We're going to take the first year and we're going to drag it across. And there we go. And there we have our cash flow statement. Once you do this, then you could start linking line by line to your balance sheet. There's different ways of linking to the balance sheet where you could check that your balance sheet is consistently balances every time you insert, a line item here from the cash flow statement. But, I'll show you that. It's my own way of doing it. But I guess I guess we could check if there's any questions on the cash flow statement, Paul. And if not, I guess we could stop here and continue this in the next session.
Yeah, Luis. No, nothing in terms of the technicals. Just a couple of people had asked. I don't know if you can. Did I shut it down? Some people had asked about the books. You can get them on Amazon. I also mentioned at the beginning, if anyone's interested in this in a lot more detail, we have programs in the summer, and we have programs in one starting in January where students can come in and actually get this type of training, but it's full semester long. It's 154 hours plus an internship, and we have a half semester. We have a 4-week program. So if anyone's interested in any of our programs, just let us know. Here's a link to the books. Financial modeling and valuation is what we're doing now is a very, very generic version of the detail you can get there. And here's our information, nyschooloffinance.com. We look forward to the next one. The next one, what we'll do is we'll send an update. We'll upload this to YouTube so you can kind of follow if this was a little fast. We'll send you an email of where we are at with the model, and with the next session, we're going to go through the balance sheet, the depreciation, the balance sheet, the debt schedule, complete the model, and then kind of take it from there. So thank you guys. Tell your friends about this. Again, there's no cost to this, so just you can send the links around. And if anyone else has any questions, feel free to find us on LinkedIn or to email us.
All right, great. See you guys next session, guys. Bye.
Okay, bye-bye.